time then to bring on board our market experts. Joining in on the show this evening, we've got ICICI Prudential's Manish Gunwani, Edelweiss Financial Services Nitin Jain is here with us as well. Gentlemen, both of you, many thanks for taking time out for us. Manish, let me begin by asking you, markets of course trading at a record high. What do you believe is fueling the rally, and more importantly, do you think we will go higher from here? Do you believe that we still have it in us?
Well, I guess elections obviously have a very important role in this recent rally, and I guess a lot of investors are definitely looking at domestic cyclicals in terms of their business prospects improving after the election. Overall, from a 1 to 3 year perspective, we maintain what we've been saying over the last couple of quarters, that if you dissect the market in two dimensions, one is mid-cap versus large caps, and two is cyclicals versus defensives. The mid-cap part and the cyclical part continues to have a lot of value.
Manish, which sectors do you like in the large cap space? Because lots of sectors, banks, oil and gas, cap goods, they're doing very well of late.
So even in large cap, there are certain sectors where the valuation is still attractive. So from a structural viewpoint, autos and private banks are segments where we've been positive, and we continue to be positive on those segments. We've also been looking at select PSU names. There's a lot of value out there, and we have kind of exposure to them as well.
Nitin, we've seen a lot of traction in the private banks, particularly in today's session. Is it that the stocks have significant weightage in the sector and they haven't been bought till now? Are the ones which are coming up, and with the hope rally going on, are people getting into private banks slightly late?
I think that's the nature of the beast, unfortunately. I think there was a time not more than 4, 5, 6 months back when everybody was writing off banks, including private sector banks. And there was a reason for that. I think the NPA crisis still, I think, is not over, and there are issues around the balance sheets. But see, how the way sentiment moves is very, very fickle. And right now, if you have a positive sentiment on the Indian economy, and if you think election can be a big catalyst, then banks are a brilliant play, because they're trading at good quality. Private sector banks are trading at 1.2 kind of book value. And I think people are now playing out that hypothesis that maybe things are bottoming out, and post-elections you can see a far more buoyant capex cycle, which will probably take away focus from the NPAs that we've been talking about, and growth will come into vogue. And I think that's very natural. I think they were under-owned, they got beaten down by 10, 15, 20%, good quality stocks available at cheap prices, and now they're getting some attention.
Manish, do you think, asset quality concerns and pressures perhaps have now peaked out for banks? And if you do agree with that argument, what do you like best then in that space? Is it the PSU lot, private banks, or NBFCs?
Well, it's difficult to say if asset quality pressures have peaked out, but what will happen is the stocks will bottom out much before asset quality pressures peak out. And that point, I think, is pretty clear. In terms of PSU versus private banks, I guess you have to be stock specific right now. You cannot take a blanket approach saying one category is better than the other, because the valuations are very, very different. So there are some assumptions in the PSU space where you can make a case that the bottom is close by, but certain other stocks, maybe the worst is not behind us. And private banks, though structural in nature, obviously the valuations are not as cheap, so you have to choose the stocks between them.
Nitin, markets expect the investment cycle to pick up, and that is why you are seeing buying in capital goods. Are you convinced about that argument?
See, I think you have to be very clear about your core hypothesis. If your hypothesis is that we have bottomed out and the economy has a very high probability of a upturn, even though it's marginal, and even though if you think 1.5% incremental GDP growth can be achieved and the sentiment is turning, then I think most of these capital goods stocks can be multi-baggers from these levels. But how much pain you have to go through will be a function of when the capex cycle takes off. It can be 1 year from now, it can be 2 years, it can be 3 years. So a lot of these stocks, including stocks like L&T, which have rallied 40-50% from the bottoms, can easily be doublers in 2-3 years if that hypothesis plays out. And if that hypothesis doesn't play out in 6 to 12 months, you would see these stocks again going back into significant pain by maybe around 20, 30, 40%. People will dump these stocks, and a new fresh set of investors will come and start to pick those stocks. So I don't think it's about these capital goods stocks. It's a core call on the economy, and based on that you have to take your calls.
All right, gentlemen, now we'll have to just ask you to hang on, because news just coming in that the poll panel has said that for now the new gas price issue is sub judice, and that pretty much means that the 1st of April deadline that we were looking at is clearly going to be deferred. In fact, Election Commission has made it pretty clear. They have asked the government to defer the notification